Hello, welcome to the special edition of 18 Hours Market Watch. We're keeping a close eye on how the US markets open trade today. And remember, the countdown is really to hitting the all-time high, record high for the S&P 500, and we are tracking a level of 2134 there, a level that was reached in September 2015. So in less than a year's time, the market has pretty much made a U-turn from the February lows to actually make an attempt at a fresh all-time record high. The Nasdaq as well as the Dow Jones ended well in trade on Friday, and the initial ticks will start coming in, but you would look at a level of 2134 coming in for the S&P 500, which will be most critical. It's also about sentiment and the way the markets have come back despite the China worries, despite all that mayhem the first 2 months of the year, all the concerns regarding global growth slowdown. And of course, the final nail in the coffin, at least for the first half of the year, was the Brexit vote, which surprised everybody on the street. The resilience of the market, the comeback for the markets has been remarkable, and it's not just emerging markets, but also the developed world. For the FTSE as well, last week it was a fresh 2016 highs in local currency terms. So all in all, the sentiment on the street has been very encouraging. We'll, of course, get you a quick roundup of the markets as and when they open trade and highlight how the initial ticks are panning out there for the S&P 500, for the Dow Jones. And yes, in fact, we are at an all-time record high for the global indices. Let's just bring that up. 2137 at open. That's where the S&P 500 is. If you could just highlight that, the S&P 500 has hit an all-time high, intraday high that is, and it's remarkable the way the markets have come back. If we could just bring up the year-to-date chart on the S&P 500, I think in a very dramatic year, plagued by a lot of event risks and global event uncertainties, the markets have been remarkably resilient, and that's really the highlight that one needs to focus on. That's a 52-week chart. The year-to-date on the S&P 500, the last 3-month performance of the S&P 500, and the last 6-month performance of the S&P 500 would be telling in the way this index has come back, which of course gives you a sense of the broader market participation in the US markets on Wall Street largely. 3.5% over the last 3 months. Extend that timeline to 6 months and then extend it to the year. In a very, very weak year, like I said, plagued by global events, the S&P 500 has returned in the last 6 months 10%. That's some telling statistics to go by with, and it just reflects on market sentiment. We have two gentlemen joining us to make sense of what's happening in the US markets. How does the story go forward from here? Gavin Friend, Director Market Strategy at National Australia Bank, joins in with his perspective. We also have Hugh Albert Johnson, Chairman and CIO Hugh Johnson Advisors, joining us with his views, and Atul Lele, who's Chief Investment Officer at Deltec International Group, joins in with his perspective as well. Thanks very much, all of you, for taking out the time to speak with us. Good evening from India, and good morning in the US. Gavin, let me start off with you first. How do you look at this all-time record high in intraday trade at open for the S&P 500? Is there more in store in this up move, or would we see somewhat of a case like it happened in September 2015 ahead of the Fed's decision on hiking rates? Post that, the markets go into a bit of a limbo.
Well, good evening from London. I think US markets are in something of a sweet spot at the moment. I think this is thanks to the combination of some better looking US numbers we had last week, economic data in terms of both the manufacturing and non-manufacturing ISMs, surprised market consensus. Then we had the bounce back in the non-farm payroll, job creation numbers at least on Friday, very healthy number there. And then in the kind of post-Brexit backdrop, which markets are taking to mean that no rate hikes for some time to come. You've got to look at, if you look at what's priced in for December this year, only about 25% probability of a move there. You've got to go right to the back end of 2017 to get any pricing above 50%. So I think, with regards to the data, the Fed may well take Friday's 287,000 job creation, or 252 if you strip out the Verizon strike effect, as saying, well, the weakness that they saw in April and May will be behind them now, and they can start thinking about the kind of job creation perhaps that they were seeing in the first quarter of this year and obviously through 2015 and 2014. So I think it's a combination of two things, some better data and the way that markets are just taking the whole Brexit environment and thinking, well, there's no way that anybody's going to push any rate hikes through at this point. The question that begs, of course, is what happens to the Fed from here? Do they try and do what they did to the market in April and May and push back on this, given pricing is just so low, and try and get markets to kind of price in more than they are currently at the moment? And I guess the risk there is if they do that and they keep pushing on it, that may well upset this kind of steady state that we have for markets at the moment. We do have, I think, no less than 9 Fed speakers on the tape this week, beginning with Esther George from the Kansas City Fed in less than half an hour, and of course she is a noted hawk, and it wouldn't be surprising to see some encouraging remarks from these guys. How the market takes it, I think, is going to be all key.
Oh, yes, indeed. Hugh, before I come to you, I just want to highlight for the benefit of our viewers, the rally in the U.S. markets and some of the key triggers that have propelled this move. Of course, everybody knows that the June jobs data was super strong compared to a very weak May data. In fact, that's been seen as an aberration, the dip in May. The Fed rate hike, as Gavin just pointed out, may get delayed. I mean, December 2016 is perhaps the most latest expectation on a rate hike, reasonable from a timeline perspective. It could be beyond that as well. The Bank of England is set to announce a rate cut by the end of this week. So it just highlights how there's coordinated central bank action across the world, which is indicating an accommodative monetary policy stance. Shinzo Abe being re-elected as Japanese Prime Minister essentially means that the same policies and an accommodative move will continue in Japan. And Q2 2016 for US earnings are expected to show a pickup versus a sluggish Q1. Not just that, even in terms of the overall GDP numbers, Q2 is expected to spring up quite a surprise at 2.5% compared to Q1. All of these factors are helping the markets, so to speak. Hugh, but just highlight the nature of this resilience. I mean, if you were to point it out to one reason which comes top of the mind for the markets to rally this much in a year when China worries, gave us quite a bit of a setback. We were worried about the uncertainties looming in the crude market as well as the commodities universe. And then the Brexit vote has just enhanced all that probability of what happens next.
Well, it's pretty clear that it's the numbers themselves that really speak for themselves. And the U.S. numbers, even if we take a look at the bad numbers, unemployment, if you smooth everything out, it's fairly clear that despite the problems, the slowdown in China, despite the perspective or the prospects of a slowdown both in the UK as well as in Europe, neither of those are going to sort of be transmitted to the U.S. We certainly worried a lot about it, but neither are going to be transmitted to the U.S. and cause us to have a recession, a bear market and a recession. So it's really the numbers are speaking for themselves. And of course, most of all, the employment numbers that we saw last Friday, which more than offset the numbers that we saw for the month of May. I would simply warn everybody about this, is that although these numbers have been good, and although the U.S. economy is going to do better in the second and third and fourth quarters, certainly than it did in the first quarter, we're not talking about very strong growth. We're talking still about growth of 1.9%. That's the consensus for 2016, and only 2.2 for 17. And we're also talking about very weak earnings growth. So yes, it's really good news that the stock market is reaching a new high. Yes, that really kind of stirs those animal spirits. But let's keep in mind that the numbers, both on the economy as well as earnings, although they're on the economy going to be positive, they're not going to be particularly great, particularly on the earnings side of things. So making the case for a significant move up in stock prices from current levels, unless it becomes very speculative, is very difficult.
Yeah, that's a very important point Hugh has brought up. And Atul, I just want you to come in on that because, Yes, we are rejoicing the fact that the US markets in a very tough global environment have done very well. In fact, a lot of equity markets world over, but what's happened has been typical atypical actually, since the Brexit vote announcement, because you've had bonds rally, you've had precious metals rally, you've had safe haven trades rally, and you've had risky assets rally. Is that a sign of caution? Is that a sign of being skeptical right now, or being confident that things are looking good? Because on the ground, there's still much pressure on growth globally.
It's a really great question, and really for us, for what we're doing with our clients at Deltec, is we're positioning our clients in this environment where, to your point, everything's rallied. It's really now from here on in about asset allocation and about sector allocation. In a world where across fixed income markets, 10-year yields are in negative territory in Germany, in Switzerland, in Japan, across many parts of Europe, where US 10-year treasuries are currently printing below 1.4%, fixed income markets have really gone as far as they can. So that's the point where we say that in sovereign yields, yes, there's a search for safety, but in real terms, investors in these assets over the next 10 years are going to earn negative real returns. That's in sovereigns. If we look elsewhere across fixed income markets, we're seeing high yield credit as being very, very expensive right now. So from an asset allocation perspective, fixed income isn't the right area to be. It's really about being in equities, because we believe that the global economic expansion will continue. It will be led by the US, where data continues to improve. We're still mid-cycle in the US. We're not late cycle. We've still got an environment where rates are going to be normalized at a gradual pace. And so when rates start to go up, fixed income will be the most negatively impacted. When economic data starts to improve even further, equities will be the greatest beneficiary. So from an asset allocation perspective, we prefer equities over fixed income. So in this environment, to your point, where everything's gone up, asset allocation is important. Looking into sector allocation, to this point where US equity markets have rallied quite substantially and hit an intraday all-time high today, it's really about sector allocation, where we want to be positioned towards those sectors which are exposed to economic growth. That is selected financials, technology, consumer discretionary, and housing, which are our top overweight positions within our portfolio. And we're staying away from those interest rate sensitive sectors, which are bond-like instruments, which to our view are overvalued, areas such as REITs, areas such as utilities. So it is a very difficult market where everything has rallied. We're really positioning ourselves towards growth-sensitive assets such as equities, and then within equities, growth-sensitive sectors, and away from liquidity-sensitive assets such as utilities and REITs. Now, to your point about precious metals and commodities, finally, these are sectors which are liquidity-sensitive, in that when US dollar liquidity conditions ease around the world, precious metals and real assets rally. As that liquidity is withdrawn, and we still believe the Fed's going to raise rates over the balance of this year and next year, commodities and precious metals will decline, as well as that commodities are clearly exposed to China, where some of the greatest risks in the world are positioned.
That's important, Atul. But Gavin, that just leaves a big question mark on what the Fed does next. Because, if they look at their own economy, fine, growth is trending at 2.5%, mostly 2.5%, and that would be within the realms of their own satisfaction, their own targets. But world over, and as the Fed policy statement has also highlighted, there are enough and more external risks and imbalances that need to be, taken into cognizance before deciding on a further rate cut. Do you expect there to be a surprise in the works at all? Can the Fed come out and say, look, the US economy is looking really good, and before this these sort of levels and this sort of strength gets a bit too much, we need to hike?
I think Janet Yellen, in her semi-annual testimony just a few weeks ago now, made it pretty clear where the Fed stands. The Fed has acknowledged repeatedly in the last few months that they live in a very globalized, interconnected world. There's no rush to do anything. It's not as if we're living in an environment where wage rises are super strong. Arguably, as Janet has pointed out, she talks about other areas of the labour market where there's a bit more slack, and it's encouraging that the latest data shows in the higher participation rate, more people being encouraged to come back and now look for work. But I think when she looks at some of the other indicators, there's still further downside to go perhaps in terms of the long-term unemployment, those kinds of things. And the Fed conceivably could, against the backdrop of what Brexit has given us, just take a bit more time really. I think they probably learned some lessons in the last few months in terms of trying to push markets one way. And then the snapback we had in the last couple of months. So I think, for the Fed just to sort of, take their time. They've had one good labour market report last week. We're presuming they're not going to do anything when they meet on the 27th of this month, and then that just pushes them forward then to the September meeting. So that will give them the opportunity to look at the jobs numbers at the beginning of August and again in September. So it's 2 more job reports, and we'll take it from there. I think certainly by the time we come round to September, maybe there'll be a bit more, markets will be a bit more cognizant that September is not completely off the radar. I think most people are thinking it's going to be December, if at all, this year. And the Fed just needs to just take a fairly sort of pragmatic approach to this.
That could well be the case.
And understand that there are other pressures going on. The backdrop that we've been dealt on from the back of Brexit is going to take. It's a long-term issue that's going to be with us, for some extended period of time.
Right. And that could well be the case, Gavin, that, a September rate hike could be kind of reviewed in a manner, or at least the timeline for that can be rechecked. But Hugh, I just want to comment on that point because, if you look at coordinated central bank action in the world, till last year that was a big risk that the US will go its own way in tightening policy and the rest of the world would be accommodative and, the ECB would make its own plans. But look at the situation right now. The BOJ is considering or looking at least evaluating expanding their stimulus program. The Bank of England could cut rates and infuse more liquidity, which will help the markets, of course, in the banking system there. Fed so far has indicated they'll remain accommodative, and the market is working with the assumption that there's be a delay in rate hike. And ECB has also indicated that they will do as much as they can, even in this environment, to ensure that there's enough liquidity as well as support to the economy, because now there's also that heightened risk of the EU slipping into a mild recession with the UK stepping out. In this sort of an environment, if the markets have constantly been helped by more and more stimulus, more and more monetary policy action, how much more upside would it lead to? Because one opinion that I gather on the street is that it's a diminishing returns theory now. After 8 years of accommodative monetary policy, markets are now used to how this medicine works, or doesn't actually.
We're not going to get a lot more stimulus. You can't get much more stimulus out of the U.S. I would add just a couple of things, and that's number one. Yes, it's going to be very data dependent. Who knows what the Federal Reserve will do in September? Who knows what they're going to do in December? Who knows when the rate hike is? But I would emphasize that, trying to normalize rates, which is the expression we all use, is very important to the Fed. There's a lot of pressure on them to start to raise interest rates just in case something goes seriously wrong with the U.S. economy, so they'll have room to lower rates. So normalization is a lot of pressure on them to raise rates for that purpose. Secondly, we've been contemplating, or we've been focusing on the economic numbers in the U.S., and we've been sort of reaching the conclusion that maybe based on the employment data and more recent data, things are getting a little bit better. But I would also focus on the inflation data. I don't want to use the expression they're getting behind the curve, but when you take a look at the core consumer price index, that's well above 2%, which is their target. The headline number consumer price index is headed towards that 2% level. When you take a look at the wage numbers over time, they're starting to get a little bit of upward pressure, and I don't think the Federal Reserve wants to take the risk of getting behind the curve. So I think there's a really good chance of, say, September or December, primarily because they want to normalize the rate environment, or they want to get rates up to a level where they can indeed start to lower rates if things get really bad. It's an extremely difficult environment. It's a very confusing environment for investors. I'll go back to what one of the prior speakers said and emphasize that he would overweight asset allocations important, overweight equities, and underweight fixed income. In this kind of an environment with the possibility of the Fed raising rates, I would overweight equities too. I would underweight fixed income securities. But the thing I want to emphasize is that in this kind of a slow growth environment, and slow growth in earnings as well, the return on equities is going to be better than the return on fixed income, but it's not going to be that much better. And the second thing is, I would mention, when you talk about sectors, I heard about the more economically sensitive offensive sectors, right. But the sectors that have been performing well recently, that investors have been migrating to, are seeing things that are a little bit safer. Sure. Utilities, telecommunications, consumer staples. Right. Investors are starting to play a little bit safe, and that means they've seen the same thing I'm seeing. which is that the U.S. economy may be doing a little bit better, but it's not doing that much better. You got to play at least a little bit of it on the safe side of the ledger. Returns are just simply not going to be that good from this level in either the equity or the fixed income markets, although they'll be better in the equity markets.
Yeah, I mean, it's taken nearly a year to actually make it to this mark. So it's a slow process, or has been so in the months gone by. Manish Singh, strategist and head of investments, Crossbridge Capital, also joins us from London to tie in the EM view in lieu of these record highs being made in the Western world. Manish, great to have you on the show. Thanks very much for taking out the time. We've seen it with the FTSE after the Brexit vote in local currency terms, made a fresh 2016 high. Now, the US markets, I mean, this sort of a rally in a year when you've been hit by China worries, in a year when you've been hit by, literally sub $30 on crude, and then you've been hit by a historic event like the Brexit vote. How do you rationalize this move, Manish?
Yeah, I mean, I would say, Tanvir, is that the upside is capped. I mean, I do not expect that these rallies are just going to continue. And for the reasons that if you look at what is the 10-year yield on U.S. Treasury tells you, it just tells you that the nominal growth is not going to be great. Now, monetary policy is the only game in town unless we see any fiscal response. And that fiscal response is not going to come until after the U.S. election. So it just tells me that your upside is going to be capped. So you will have rallies if there has been a sell-off, and that's what you are seeing. Otherwise, there is very few upside. And the downside is also in a way capped because you have central banks which are being supported. So we are in a market, which will be sideways or volatile, but you are not going to see big rallies. So for me, positioning-wise, you have to take a position and put a limit sell order to sell when it reaches a certain level. But that is the only thing that I am doing at this time and what I recommend, unless we see a fiscal response, which I don't see coming until next year.
Right. Manish, while the upside is capped, and you have been, of course, a big proponent of how, equities are still holding on, especially emerging market equities. What's the road ahead? While they might be diminishing returns, and that's a point well taken, what's the road ahead looking like for emerging market equities in lieu of what's happening in the developed world? Is the upside still a lot more there?
See, I mean, I would say there will be some upsides. I'm not by any means, I'm not bearish. I'm just saying that, the growth criteria which really determines, that how well emerging markets do or the dollar story. I mean, relatively speaking, emerging market looks a good place to be purely from the local growth point of view and the point of view that you're not going to see a rapid rally in US dollar, not least because Fed is not going to raise rates probably until December. So it makes you think that you should be in that market, and relatively it looks a much better place to be. But then it just means that the big upside that you see from a secular growth story, that is missing. So on relative basis, yes, it looks attractive. But if you would ask me that, will you see big rallies? No, I don't think so, because I think that is pretty much driven by the global growth cycle as well. And there we have some questions. And as you know yourself about the whole Brexit story, we still see that there will be some slowdown in Europe, in EU and UK. And, we are not seeing a big growth in the US, and therefore you're seeing the 10-year yield, which is trading at 1.36 now. So on that basis, it will rub on the emerging market. But emerging market, I would say, on relative basis, looks a far better place to be than the developed market. There is no doubt about that.
Right. Okay. So let me get in closing thoughts. Hugh, what's your own sense? I mean, some summary of this special moment on Wall Street today. Is that, yes, the picture is looking good for the day, but it's not like the underlying fundamentals are very supportive. This could just be a liquidity adjusted move, which is fueling all asset classes, because the world would not be very happy with a very strong dollar right now.
Yeah, this is clearly a liquidity-driven rally. And it's not just U.S. liquidity, which is positive, but it's also international liquidity with the dollar being as strong as it's been. So that's really it. And you're absolutely right. The underlying fundamentals, it's very hard to support stocks at current levels, particularly the earnings picture, not just for the first quarter, which we're about to look at, or the second quarter, which we're going to look at, but all of 2016 and 2017. And that's why we're sort of very, very cautious at current levels. The underlying fundamentals are certainly not that good. And there's a lot of uncertainty. Now, believe me, the stock market going to a new high is really good news. It might take the news about the stock market from the financial page to the front page, if we're lucky, and that will stir some animal spirits and maybe getting us into a little bit of a higher, more speculative environment. But I do think, and you pointed it out and you said it very clearly, that the fundamentals, it's very hard to justify stocks at current levels, and especially that earnings picture, which is not that good.
Right, so the euphoria could be short-lived. Manish, specifically to emerging markets and specifically to India, because we are also looking at the markets and rejoicing a bit on 8450 being crossed on the Nifty. You were, I remember, putting a cap at 8500. Do you think that pretty much would be it? That the upside to this market would stay at 8500, 8550 odds?
Yeah, I do think that may be the case in the short term, because we have hit a new high in US, as we have seen. I do think that this market is not going to be just a one-direction rally market. So you will be sell-off and then people will reposition again. And the simple reason for that is you are not seeing really big growth numbers. And therefore, if you are a holder, then you should rather look to sell and reposition and wait for a sell-off and then to pick your long bet again. But I do think that we are going to hit some such caps, and you should take opportunity to sell off and reposition for later.
Gentlemen, thanks very much for taking out the time to speak with us. It's a momentous day on Wall Street as the US market, especially the S&P 500, has hit an all-time intraday high. It's retraced from there, but even so, the moment has been marked. And even for the Dow Jones, fresh 2016 highs, but remains to be seen how much more upside is there from these levels and whether or not these rallies are sustainable. Like Manish pointed out, tie it in with the EM impact of this US market rally and India impact. And it seems like we would, at least in the short term, pretty much mirror what's happening across the world. So there would be more upside, but that could be limited and capped. Thanks very much for watching the special edition of ET Now Market Watch.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.